Hi guys, very good evening all of you. Welcome back to Cap Classes. So, how are you? Shall we start today's class? Today we are going to discuss a very important part of financial statements, that is cash flow statement. Do you remember in your first day of auditing class your teacher might have told you, or in your first day of accounting standard class your teacher might have told you a phrase, general purpose financial statements. So this general purpose financial statements, a full set of general purpose financial statement includes a balance sheet, income statement or P&L account you call, statement of changes in equity, cash flow statement, notes to accounts, isn't it? So cash flow statement is also a mandatory part of financial statements of any company. If you are a listed company, it is mandatory. If you are a public limited company, it is mandatory. If you are a startup private limited company or a one-person company or a dormant company, there are certain exemptions from preparing cash flow statement. But a regular company, if you take a healthy company, preparation of cash flow statement is a must. So in the introduction part of this standard, ICA told that this is applicable to all the level 1 enterprises, but it is recommended to each and every enterprise. Even if you are a small company also, or even if you are a partnership firm or sole trader also, it is recommended to have cash flow statement as a part of your financial statements, because cash flow statement speaks a lot. It speaks a lot. So before going into the syllabus today, I'd like to give you one two very important points from stock market's point of view or reality point of view, the real life business, how it is going. I'll give you one small example. Flipkart is in losses. If you look at the accounts of Flipkart, yes, Flipkart is in losses. But Flipkart's investment is not even, their capital employed is not even 5,000, 10,000 crores. I don't think their capital is more than 5,000, 10,000 crores. But do you know what is the value assigned by Walmart when they are taking over Flipkart a couple of years back? It is 1,06,000 crores. That means almost 1 lakh crores or more than 90,000 crore rupees is given as a goodwill for loss making company. So far, right from your +1, you have been taught value goodwill at 4 years purchase of super profit. Like this you valued, correct? Even in your partnership accounting also, you will calculate profit, you will calculate normal profit, super profit, and then that super profit you will multiply with 2 years, 3 years, 4 years, and you say this is goodwill. But beta, that is there only in accounts books, not in the reality. In reality, the weight or the goodwill is not assigned based on the profits of a company. There are so many businesses which are in losses, which have huge value, very big value. Now the question is, Pavan sir, when a company is in losses, still you want to buy the company, still you want to pay the goodwill, still you want to give huge chunk of money as goodwill? The answer is yes. Why? Why? Though there is no accounting profit, the business is running in losses. Losses are not small amounts also, hundreds of crores, thousands of crores of losses, but still companies are ready to pay thousands of crores or maybe lakhs of crores towards goodwill to acquire this company. The question is why? The answer is, in real life, the valuation is based on the cash flows. The valuation is based on the cash flows. It is not based on the accounting profits. No business is valued looking at the accounting profits. Now you'll say, then Pavan sir, my whole life is, my whole learning, whatever I learned is only a fraud. It is a myth. In financial management, they said that valuation approaches are there. EBIT divided by KO is equal to value. EBIT into 1 minus tax rate by KO is value, or your operating profit after tax, NOPAT we call, net operating profit after tax divided by that discount rate applicable to that particular industry is value. This is what Modi Glani Miller said. This is what net income approach said. This is what net operating income approach said. In my accounts, my teacher told me to do the fair value of all the assets and liabilities, add goodwill calculated based on the profits. This is the value. But I'm telling you, all these are theoretical and are only in the books. In real life, there are so many methods of valuation. Do you remember in financial management, you have calculated discounted cash flow models, DCF. Value of share is equal to D0 divided by KE. P is equal to price of the share is equal to D0 by KE or D1 by KE into growth rate, 1 plus growth rate. Do you remember all this stuff? D1 by KE plus growth into 100. So all these valuations, they are from different points of view. But in reality, I have 15 years of experience as a chartered accountant. I have done so many, mergers and acquisitions, due diligence also. Any business takeover proposal you take, it is based on cash flows. If you are able to generate cash flows, even though you are in losses, beta, you will get huge value. On the other side, imagine there is a company with huge accounting profits, but cash crisis. There is a company with huge accounting profit, 1000 crores accounting profit is there, but the company is having working capital problem. The company is not having adequate cash flows in hand. No one will buy this company. Even if you say, Pavan sir, the company with huge accounting profits, Pavan sir, no one will buy that. That can be a cash trap. You will die there. So, profitable company with cash problems, I don't want. Loss-making company with good prospects of the future, having some good credentials, like existing customer base or technology or the scale or the brand value, you are having losses, but still your cash generation ability is good. I want this kind of companies. Point number 1. This is the significance of cash flow statement. Point number 2. The whole world of accounting revolves on one fundamental accounting assumption, that is going concern assumption. Going concern assumption, isn't it? So, the company prepares financial statements based on going concern assumption, correct? Imagine you are conducting audit, so that the 570 and all these standards on audit are there, no? So, you are verifying going concern. Have you read the standard properly? Do you know how to evaluate the going concern ability of the company properly? You are conducting audit of a company. The financial statements are prepared based on going concern assumption. Now, as an auditor, you need to verify whether the entity is a going concern or no. You need to verify whether there is any material uncertainty relating to going concern or no. Isn't it? Based on that, you have to give your audit report. No, in audit report, material uncertainty paragraph is there. You have to write whether the entity is a going concern, whether there is any problem to going concern. Based on that, sometimes you will give adverse report also. Sometimes you need to give qualified report. You remember all this. Now you tell me, how will you decide whether an entity is a going concern or no? Management will assess the going concern ability of the company. That is a different story. If you are Reliance Industries, it is the responsibility of Mukesh Ambani to do going concern assessment. It is not the responsibility of Pavan being the auditor. If Reliance Industries has Pavan as auditor, it is not the responsibility of Pavan to evaluate the going concern ability. It is the responsibility of management and board of directors. Isn't it? So they have done. Do you know how they do going concern analysis? Is it based on profits? No. No way. You cannot say, I have profit, my entity is a going concern. No way. Going concern ability is done by preparing cash flow statement. Do you know that? Projected cash. So many people do not know. Unless you are actually into core practice, you do not know this kind of points. Sometimes, even CA inter-level accounting also can be handled by a professor who has a very good knowledge in accounting. So, no disrespect to them. That means so many great people are there, to everyone salutes. So, but the problem is, if you are a lecturer who teaches only with theory, you do not understand the practical facet like this. But because I have done enough audits in my life, I'm telling you, going concern, even when you read international, global books also, even in international books, this is very clearly given. But unfortunately, in Indian books, in Indian accounting standards, auditing standards, in Indian books, this is not highlighted. The auditor has to evaluate the management's, assessment of going concern. That is there. How? Nowhere it is told. Even if it is told in the corner of the auditing standard also, our student will not read in that depth, no. And going concern of an entity is assessed looking at the cash flows, not looking at the profits. Now you understand the significance of cash flow statement, because all the students by default they believe trading P&L account, balance sheet, they are financial statements. Cash flow statement, wo bhi hai, that is also there. No, that is very important. And remember one thing, okay, if you are a financial analyst, you start analyzing a company from cash flow statement. First thing you look at is cash flow statement. Second thing you look at is balance sheet. Third thing you look at is P&L. Interesting, no? Pavan sir, but in my whole life I thought P&L is the first important thing, second important thing is balance sheet, third important thing is cash flow. No, cash flow is first, balance sheet is second, P&L is third, in the order of priority for financial analysis. That means this particular element of, part of financial statements is very important. In real life, this drives the value of a company. This drives the ability of an entity to be a going concern. This drives the ability of an entity. The cash generating ability drives the going concern. You understand? Now we'll see one thing. So how this, cash flow statement looks. Let us see one annual report. Okay, this is the annual report of Unilever India Limited, one of very good companies, fundamentally very strong companies, which is into FMCG and all. You take 100 products in, this detergents or toilet preparations, toiletry soaps and all, or you take, house cleaning things, or you take any product. Okay, like in cosmetic corner of any supermarket, more than 50% of products belong to same. You name you name any popular brand of soap or of shampoo or of detergent, that is from this company only, Unilever. So on the screen, Unilever cash flow statement I have opened. Latest cash flow statement, 31st March 2020. 2021 has not yet come, no, 31st, because we are sitting on 22nd March. On 31st March, financial year ends. So as far as the availability of data is concerned, this is the latest cash flow statement of Unilever. I have downloaded this just to show you. Okay, so all of you just read whatever is there. A, cash flow from operating activities. What they have done? They have taken profit before tax. So this is, if you have minimum common sense of the accounting standards, Pavan sir, indirect method, Pavan sir. Yes, correct. Cash, see, basically there are three types of cash flows. Cash flow from operating activity, cash flow from investing activity, cash flow from financing activities, correct? There are two signs of cash flows. One is inflow positive sign, one is outflow negative sign. Cash flow statement is nothing but cash book. Okay, in ledger accounts we have cash account, cash receipts and payments. So that cash receipts and payments account is nothing but cash book, this cash flow statement. But what we are doing is, instead of giving 20 receipts, 20 payments, we are classifying those receipts and payments into three buckets. First bucket is known as operating activity bucket. Second bucket is known as investing activity bucket. Third bucket is known as financing activity bucket. So cash inflows and outflows are classified into three buckets, three categories: operating activity, investing activity, financing activity. So cash flow from operating activity, positive, negative. Cash flow from investing activity, inflow, outflow, positive, negative. Cash flow from financing activity, positive, negative. You understand? In this investing activity, financing activity, there are no two methods. There is only one method. There are no two methods. There is only one method. Which method? Direct method. What is direct method? Cash inflow XXX minus cash outflow XXX, net cash flow XXX. Khatam. Cash inflow minus cash outflow, cash receipt minus cash payment, net cash. That's all. This is called direct method. So for investing activities, financing activities, only direct method. For operating activities, there are two methods. One is called direct method, another one is called indirect method. Again, direct method is same. Cash received, cash received, cash received, add cash paid, cash paid, cash paid, subtract net cash. This is direct method. Indirect method means take your P&L. Take your P&L. Profit after tax, net profit after tax, PAT. Add back taxation. Add back taxation. It becomes PBT, profit before tax. To that you will make few adjustments. You'll make few adjustments. What are the adjustments? One, non-cash moving items like depreciation, provisions, add back, add back, add back. And you adjust cash flows which are falling in the second or third bucket. What are we looking at? Cash flows from operating activities. You opened P&L, in the P&L to interest paid 10 crores. That interest paid is on loan. Loan borrowed is financing activity. On that, when you pay interest, this to interest paid is finance charge which should go to third bucket. But already that is in the first bucket. So what are we supposed to do? You adjust it here, add back it here, and you subtract it from third bucket. In third bucket, you will put to interest paid in brackets 10 crores. Why? Outflow. You understand? Dividends received from subsidiary company. This should fall in second bucket, investment bucket. So I invested money in subsidiary company. Investment is second bucket. From this second bucket, if I am getting return on investment, that also should fall in second bucket only. So dividends received is second bucket. But what I have done in my P&L account, I have written by dividend received from subsidiary company 25 crores. So I am calculating operating activity cash flow, but investment activity cash flow is coming. I have to say, oh, hello, bro, listen, I will adjust you here from operating activity. I will send you to your appropriate home. By mistake, you came to my home. Your home is this bucket. Okay. So take it from here, subtract it from operating because it is credit. You will put it in investment bucket without brackets because it is inflow. Dividends received from subsidiary company, cash inflow 25 crores. So in indirect method, what will I do? Take profit after tax, add back tax, it will become profit before tax. From that, make adjustments. How many adjustments I told you? So far, I told you 3 adjustments. 1, add back non-cash moving expenses like depreciation and provisions. Okay. 2, any cash inflow or outflow from operating from investment activity, or any cash outflow or inflow from financing activity, if it is already considered in P&L, remove it from P&L, put it in relevant bucket. This is adjustment for investing and financing cash flows recorded in P&L. This is adjustment 2, adjustment 3. Adjustment 2, investment activities. Adjustment 3, financing activity. Then comes fourth one. What is the fourth one? Non-operating items like profit on sale of assets, loss on sale of assets, profit on sale of investments, loss on sale of investments. They are also to be adjusted. Adjustment 4. Adjustment 5, a very important adjustment, working capital changes. What is adjustment 5? Working capital change. So when you take PAT, add tax, it will become PBT. Then adjustment 1, 2, 3, 4, 5. Pro forma is there. Very simple pro forma. I am sure you might have studied this in +1, +2 also. Nowadays, you know, in some international curriculum, students are studying cash flow statements in 9th standard, 10th standard. So this is not any nuclear science. Okay, understanding the intricacies and the corners is more important. Take a question from ICA study material, solve it. You can do it in a matter of ziffy. You can just snap, problem is over. You can do that. But I want you to understand in reality how it happens. So EA, what is EA here? cash flow from operating activities, hi bolo. Then B dekho, cash flow from investing activities, hi bolo. Okay, then C, cash flow from financing activities, hi bolo. So now you understand there are three buckets: cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. Ah sir, okay. Then A plus B plus C. A, operating activity cash flow. B, investing activity cash flow. C, financing activity cash flow. Put together total net cash flow. Why we are using the word net cash flow? Because already we are netting off positive and negative cash flows. No. So positive cash flow without a bracket, negative cash flow with the bracket. I am netting it off. So net cash flow. Then you will consider opening balance of cash, which includes three elements: cash plus cash at bank, cash in hand plus cash at bank plus cash equivalents. What is cash equivalent? We'll see in 2 minutes. Cash in hand plus cash at bank plus cash equivalents. All the three put together, what is the opening balance? What is the closing balance? Okay, so take the opening balance, and to that add this net cash flow, then you will get closing balance. So this is my balance sheet. This is my balance sheet. In this balance sheet, this is asset side. This is 2021, this is 2020, 2 years. Here cash and cash equivalents 120 crores, 92 crores. One shareholder asked, Pavan sir, you are CFO of company. Pavan sir, cash balance is 120 crores, sir. Last year closing is 92 crores, sir. Last year closing is current year opening up. Pavan sir, how this 92 has become 120, Pavan sir? You are CFO of company, explain. I said, Ray, rubber manda, turn the page. In the next page, cash flow statement is there, which is reconciliation of how this 92 has become with ups and downs 120. This is cash flow statement. Now the shareholder will ask, oh, cash flow statement is reconciliation between opening and closing. Yes. So take opening balance of cash, add operating minus operating activity, add investing activity minus investing activity, add financing activity minus financing activity. That should be closing. Simple, no? So how this 192 has become 120? That is cash flow statement. Now Chintu will say, oh, sir, cash flow statement is this easy, I never know. Cash flow statement has this much of meaning, I never know. Congratulations to you. Welcome to CAP classes. So you are reconciling between opening balance and closing balance. Now look at our financial statements of this published company. So they have taken cash and cash equivalents at the beginning of year. Can you see 575 highlighted there? 575. Then the closing 3130. So now shareholder is asking, Sare, oh Sare, how 575 has become 3130, Sare? How Sare? Please tell. Then you will tell him, beta a calculator low. Okay. Take opening, sir, 575, okay, plus current year A plus B plus C put together 2555. Okay, take that, add to 555 is equal to press karo. Okay, 3130 aaya. Hey, correct. Now again shareholder will ask, sir, that 2555 is there, no? What is that 2555, sir? Then you will say, hello, ये है ना यहाँ, ये कितना है 7305. This is A 7305. Cash flow from operating activities. Okay, and plus 1926 cash flow from investing activity. Okay, that comes to 9231 minus 6676 cash flow from financing activity. Oh my god, sir, 2555 came, sir, rubber manda. This is that only, no? Congratulations to you. So basically in cash flow statement, what I am showing, you know, opening balance of cash, add cash inflow from operating activity minus cash inflow from operating activity, add cash, sorry, this is outflow, add cash inflow from investing activity minus cash outflow from investing activity, add cash inflow from financing activity minus cash outflow from financing activity. This is A plus B plus C. This is closing balance of cash. So this you know when you are in second standard or LKG UKG also. Then you thought opening balance of cash, add opening balance of cash, add cash receipts minus cash payments is equal to closing balance of cash. This is also same, but instead of writing add cash receipt minus cash payment, I am putting this in three buckets. Bucket A operating, bucket B investing, bucket C financing. That is this cash flow statement. That's all. You understand? Now look here. Take profit before tax. Already they have taken profit before tax only. If you take profit after tax, you would have added tax. Then it becomes profit before tax. But these people have taken profit before tax only. Good, no? Then depreciation, non-cash moving expenditure, add karo. Non-cash moving expenditure, add karo. Profit or loss on sale of property, plant and equipment, non-operating item, add or less. Government grant, non-operating. Contingent consideration upon business combination. This is Ind AS 103, which is not there in your syllabus. You do not know what is contingent consideration and business combination. Chhod do. Okay, you are playing gully cricket. Okay, this is international cricket. Stunts are performed by professionals. Do not imitate at home. Okay, so finance income, Pavan sir, ये finance income क्या है? Interest received. Finance income is interest received. Dividend income, dividend received. Pavan sir, why are we adjusting? Because this dividend income 96 is there, no? Dividend income 96, that I am subtracting from here. In investment activity, I will put it as inflow. Investment activity में यहाँ देखो कहीं पे that 96 will come from here. Dividend 95 plus 1. 95 plus 1, 96. You have put it here, 96. I told you, right? So, what did I tell? Take PBT, one, add back non-cash expenses, then add back non-operating items. Add back or subtract non-operating items. After that, finance activity or investment activity, adjust here, put it in second or third bucket. Your house is somewhere, by mistake you came here. So I will subtract you from my family. I will drop you in your flat. Okay. So fair value loss on investment. This is Ind AS. This is also not there in your syllabus. Don't worry. Interest expense. This is interest income. This is interest expense. This is also same. Interest expense. I'll add it back here and I'll put it in third bucket. Third bucket. Go to third bucket. Interest paid 106 will be there. Okay, interest paid on lease liability, interest paid on other than lease liability, something they have shown, no, accounting 74, 6 and all, some accounting, you know, reconciliation they might have shown, but basically this interest expense is there, no? This interest expense will go to third bucket. Interest expense will go to third bucket. Provision, non-cash moving, add kar do. Impairment, non-cash moving, add कर दो. Inventory written off, non-cash moving, add कर दो. Bad debts, non-cash moving, add कर दो. Mark to market gain, fair value gain, add कर दो. Or subtract कर दो, based on which side of the P&L it is coming. Then cash generation from operating activities before working capital changes. Then you will do working capital changes. Current asset increased is to be subtracted. Current asset decreased is to be added. So remember it like this. Working capital adjustment. So cash flow from operating activity before working capital adjustment is dink chikadam xxx. Cash flow from operating activities before working capital adjustment is XXX. Then you will do adjustment for working capital or working capital adjustments. Here 4 adjustments will come. Okay, 1. Increase in current assets, subtract. 2. Decrease in current assets, add. 3. Increase in current liability, add. 4. Decrease in current liability, subtract. Then you will say this is cash flow from operating activity after working capital adjustment. Then you subtract tax. Then you will say this is cash flow from operating activity net. If it is a negative number, you will say cash lost from or cash used in operating activities. If it is a positive number, cash flow from operating activity. If it is a negative number, cash used in operating activity. Now Chintu will ask a doubt. Pavan sir, what is the reason behind this, Pavan sir? And sometimes it is confusing, sir. In the examination hall, I will sleep upside down and I will think current asset increase, add a less, add a less. Khatam. If one thing is wrong, all the remaining 3 also will be wrong. How sir, how to remember that? I will tell you what is the logic behind this and I will tell you how to remember this also. How to remember this? Current asset straight, current liability reverse. So current asset is your friend, okay? Current asset is your friend. Why? It is CA, no? You are also CA. But you are FCA, future CA. I am also FCA. Hey, nice to meet you. What FCA I am? I am fellow chartered accountant. You are also FCA, future chartered accountant. Okay, so current assets are CA. You are also chartered accountant. So current asset is your friend, okay? So current asset is your friend. And what type of friend he is? Always reverse. You have one friend who will torture you all the time. If you say yes, he'll say no. If you say no, he'll say yes. If you say we'll go to restaurant, he'll say no. We'll go to movie. If you say we'll go to movie, he'll say no, we'll go to beach. Then you say we'll go on a bike, he'll say no, auto. You'll say we'll go on auto, he'll say no, bike. You'll say bike, he'll say no, we'll walk. So that kind of third friend will be there, no? Remember him. Current asset is your friend like that. So if it is increase, decrease it. If it is decrease, increase it. Current liability is straight. Current asset is reverse. This is one. Now, Pavan sir, why am I doing this adjustment? Now imagine this is your debtor. This is asset side. This is 2021 balance sheet. This is 2020 balance sheet. Here 120 crores is there. Here 150 crores is there. Opening debtor is 150 crores. Huh? Opening debtor is 150 crores. Correct. Closing debtor 120 crores. You tell me in the chat box. You tell me, for the last 1 hour I am only shouting. You are putting your phone somewhere, zoom on and sleeping only, no? So you use your brain also. Sometimes using brain is good. Opening debtor is 150 crores. Closing debtor 120 crores. What happened? You tell me. Opening debtor 150 crores. Closing debtor 120 crores. What happened to debtors? Okay, decrease in debtors, correct. Amit, your answer is right. What happened to cash? There you are, correct. So, cash received, that is the reason current asset came down. So, what is the journal entry you write? Cash account debit 30 crores to debtors account 30 crores. This is the journal entry you passed, correct? Cash account debit 30 crores to debtors account debit 30 crores. So, cash increased, no? When debtor decreased. You understand the logic? So here debtors decreased means cash increased. Same with inventory also. Inventory decreased means cash increased. Current asset decreased means cash increased. Now same thing with the creditor. Okay, creditor, last year creditor is 45. This year creditor is 10. Last year creditor is 45. This year creditor is 10. You tell me what happened. Cash paid to creditor, outflow. So creditor decreased, cash decreased. So creditor is having straight relation with cash. That is the reason here if you observe, decrease in current liability, decrease in cash. But increase in current liability is a decrease in cash. Decrease in current liability is increase in cash. In the whole universe, no one can teach you cash flow better than this. If you are unable to understand what is the working capital adjustment, even after this explanation, there is only one option. My students will tell. What is the option? Go to 7th floor and jump from there. Or otherwise, for you, there will be a pro forma, and that pro forma you have to buy hot. How to buy? You have to buy hot, and on the day of exam, you will forget anyway. Sir, why up to date of exam, sir? Before only we'll forget, sir. After half an hour also we'll forget. Yeah, I know. That is the reason you should understand the concept. You should not buy hard. You should not mug up. So again, did I show pro forma of cash flow statement to you? The answer is no. I have not shown you the pro forma of cash flow statement. I have not explained anything theoretically, but practically we have understood everything. Now close your eyes and think of the summary. So cash flow has three parts. Okay. One is operating activity, okay. One is investing activity, okay. One is financing activity, super, correct. It has two signs. One is inflow, positive, one is outflow, negative, super. Inflow increases the cash, outflow decreases the cash, super. You remember all these things. For operating activity, there are two options, direct method, indirect method. For financing and investing activities, only one method. Direct method only. There is no indirect method for investment activity and financing activity. There is only direct method. You understand all this stuff? Now, what we do is A, cash flow from operations. Cash flow from operations. Underline. Take profit before tax. If PAT you are taking, add back tax. Profit before tax. To that, 5 adjustments. Non-cash items, non-operating items, finance activities considered in P&L, investing activities considered in P&L, working capital changes. In working capital changes, 4 changes will come. Current asset increased, decrease it. Current asset decreased, increase it. Current liability increased, increase cash. Current liability decreased, decrease cash. That's all. Then first calculate cash flow from operating activities before working capital adjustment. Do this 4. Then cash flow from operating activities after working capital adjustment. After that, take tax. Then you will say this is cash flow from operating activities. If it is positive, if it is negative, cash utilized, used in operating activities. Wait, hold on. If at all, any extraordinary item, accounting standard 5, extraordinary item, accounting standard 5, accounting standard 5, extraordinary item, that is extraordinary items. Refer accounting standard 5. If any extraordinary item is there, that should be shown as a separate line item. For example, fire accident. Insurance received due to fire accident. Insurance received is cash inflow, no? Insurance claim received is cash inflow. That you should show separately. Government grants refunded. Government grants refunded. Extraordinary item. Accounting standard 12. Accounting standard 12. That also should be shown separately. Losses due to earthquake. Losses due to enemy activity, sabotage or something they call, okay. Losses due to enemy activity. Afghanistan people have put one bomb on you. Sir, why Afghanistan people put a bomb on us, sir? United Nations report you have studied, sir. Out of 149 countries, Afghanistan and we only are friends, sir. Last unhappy countries. I was surprised to see Bangladesh, Pakistan people are happier than us. Is the report wrong or my mind is wrong? I am unable to understand. Hello, anyway, so no discussion about political things. We are here for academic purpose. Are we happy? If you are happy, that is enough. No. Why do you need 140 crore people happiness? Sir, you are a very selfish person, sir. We have to consider Sarva Manava Saubhratritvam. Whole universe is our brotherhood only, sir. All Indians are my brothers and sisters, sir. Congratulations to you. Chalo, anyway, so this is how we need to prepare cash flow statement. Understand? So if any extraordinary item is there, Afghanistan people have put one bomb on you, or earthquake, tsunami, this kind of natural calamities. Government gave you, some grant 4 years back. Now they called you, slapped you, and they are taking the government grant back. You need to pay cash now. That is also extraordinary activity. The government asked cash. You'll say, wow, extraordinary. That's all. That is also an extraordinary. That's it. Cash flow statement is over. Can we go to next chapter? You'll say, sir, you have explained only theory, how to do problems and all. Please teach me, sir. Okay. Shall we? Yes. So now see. And okay, now cash includes, I told you how many? Cash includes how many? 3 items. Cash in hand, cash at bank, cash equivalents. Cash equivalents. What is cash equivalent? Look here. This one. Meaning of the term cash and cash equivalents for cash flow statement. Cash in hand and deposits payable on demand. Oh my God, sir, what is this? Deposits payable on demand, sir. These are cash in savings accounts, current accounts. Pavan sir, cash in fixed deposit, that is not cash in hand beta, that is investment. Fixed deposit, if you have more than 3 months tenure fixed deposit, that is investment. Pavan sir, what if I have put money in fixed deposit account, that FD, the tenure of FD is 3 months, Pavan sir. Tenure of FD is 3 months or less than 3 months. That is cash equivalent. Pavan sir, what if I purchased shares? That is investment, no? What if I purchased debentures? Debentures for more than 3 months, investment. Less than 3 months, cash equivalent. Pavan sir, what if I purchased equity share for 1 month? Still it is investment only. Why? Because if there is a risk in the value of the investment, then you cannot say that it is cash equivalent. For example, I have put money in fixed deposit. That principal amount 1 crore will never come down. There is no risk. 1 crore will become 1 crore plus interest. But if I put 1 crore in equity shares, even if it is for 1 month, there is a possibility that 1 crore can become 90 lakhs, 80 lakhs, 22 lakhs, or it may become 140 lakhs also. That is a different story. So, Pavan sir, when can I say that it is cash equivalent? Padho, second point. Cash equivalents are short term. Underline short term here is not like your investment accounting standard 13. There short term means less than 1 year. Long term means more than 1 year. No, here it is 3 months. 3 months. Up to 90 days. If the problem says 89 days fixed deposit. Cash equivalent. 91 days fixed deposit. Investment. Nice no? Highly liquid investments, that means there should be no lock-in period. Pavan sir, I cannot withdraw this for 5 years. Say for example, you have some amount in your savings account or you have some amount in your current account. There is a restriction on the withdrawal. Next 5 years you cannot withdraw that. Even if that cash is in savings account also, but that is not repayable on demand, no, because this lock-in period is there. That are readily convertible into known amount of cash. If you purchase equity share, you do not know on conversion how much of amount will come. Every second price changes. But if you have fixed deposit, today if you break fixed deposit, how much will come? You know. If you redeem debenture today, how much it comes? You know. And are subject to insignificant risk or change in value. Huge ups and downs in value is not expected. Because debentures, fixed deposits, there is no ups and downs in value. Okay. Also, what if I buy gold? Gold is also not cash equivalent. Gold is also not cash equivalent. Gold is investment only. So a short term is one which is due for maturity within 3 months from the date of acquisition. Underline date of acquisition, not from the date of balance sheet. Ta-da! To make you fail, whatever the best possible thing is there, that will be given in the question. Okay, to screw your happiness. Already you are one rubber manda. Already your brain is 4 kilo. Normal human brain is 1400 grams. Okay, normal human brain is 1400 grams, 1.5 kg. So your brain will be 4 kilo only, no, 250 grams hardly, and you use 0.01% of it. Are you insulting me? No, this is reality, beta. So what they do is they'll tell you on 1st March, company deposited 5 crores in fixed deposit. On 1st March, company has put money in fixed deposit. This fixed deposit will be matured. The tenure comes to end on, they'll take April, May, June, 3 months, no? So 15th June they'll give. So 15th June give. So what is the date of purchase? 1/3/2021. This is our balance sheet. Okay, balance sheet is 31/3/21. So fixed deposit maturity कब है? 15/6/21. Ta-da! Now our rubber manda will calculate. Capital W, small w. You'll take fingers. April, okay. May, okay. June half only, no? So this is 2.5 months. So this is cash equivalent. 6 months ago. You need to check 3 months maturity from the date of acquisition. This is more than 3 months, so it is not cash equivalent, it is investment. You understand? Investment in shares are not normally taken as cash equivalents because of uncertainties associated with the value. Realizable value goes up, comes down. Okay. For the purpose of cash flow statement, cash and cash equivalent consists of at least 3 balance sheet items. What are they? Cash in hand, cash at bank in demand deposits, savings accounts, current accounts, CASA, CA SA. If you do bank audit, you will know CASA. What is CASA? For them it is demand and time liabilities. For us it is demand assets. Current account, savings account. Then the third one is investment. What type of investments? Having insignificant risk, readily convertible, highly liquid, without any risk of changes in ups and downs, short term, less than 3 months. So if any investment meets all this criteria, then you can say that it is CE, cash equivalent. Pavan sir, one of the conditions is violated, Pavan sir. Throw it in investments. It is not CA. That's all. And types of cash flows. Okay. So did we read this? Operating activity, direct method, indirect method, investing activity, only direct method, financing activity is also only direct method. Congratulations to you. Now, what is cash flow what is cash flow from cash flow. So they're explaining certain things. We'll see proformas, homework. I'll not by heart proformas and all. So I want you to understand through some examples. Okay, this we'll see later. Ta-da. No, this one. Look here. Put this in your notes. Copy this in your notes. There are two small charts. Copy both the charts. Done. Once you are done copying, let me know. Then we'll continue. Okay, now look here. I'll tell you the easiest way to remember this cash flow statement. Okay, look at the balance sheet. In balance sheet here, FA. Sir, what is FA? What is fixed asset, current asset, dude? Come on. Current liability. Here, equity share capital, preference share capital, debt. Here, reserves. So this is part 1. This is bucket 1, big bucket, operating activity. Changes in current assets, changes in current liabilities. Once are changes in reserves. Array, last year closing reserve is 100 crores. Opening P&L. Opening P&L 100 crores. Closing P&L 125. What is the 25? Current year profit, no? Correct. So reserves last year 100, current year 120. What is the meaning? 20 transfer to reserves, no? That is current year profit. Operating. So this is our second bucket. Investing activity. This is our third bucket. Financing activity. Any changes in bucket 1, operating activity? Any changes in bucket 2, financing activity? Investing activity? Any change in bucket 3? Equity share capital, shares issued, financing. Shares redeemed, financing. Shares bought back, financing. Preference shares redeemed, financing. Everything. Loans borrowed, loans repaid, interest paid. All the things are financing. This side, fixed asset side, investments purchased, investing activity. Investments sold, investing activity. Fixed assets purchased, investing activity. Fixed assets sold, investing activity. Plant purchased, machinery purchased, furniture purchased, land purchased, goodwill, intangible assets purchased. Any change in the goodwill or any change in intangible assets are also investing only. All fixed assets. Intangible assets also fixed assets, no? Changes in current assets, current liabilities is bucket 1. That's it. You understand? So what are operating activities? Principal revenue generating activities. Imagine I am running a school. From student I am collecting tuition fee. Is it operating activity? Yes. I am selling notebooks. Is that cash operating activity? Yes. I am selling textbooks, study materials. Is that operating activity? Yes. Exam fee? Yes. Lab fee? Yes. Library fee? Yes. Transportation fee? Yes. Computer lab fee? Yes. Karate? Yes. Music classes? Yes. Extracurricular projects. Anything you collect from student which is incidental to your running of the school, even if it is a hostel and food you are providing and you are collecting money also, all these are operating activities only. So many students feel only tuition fee collected, school fee collected, term fee collected is operating activity, books sold, uniforms sold, exam fee, all these are non-operating. Are you kidding me? They are non-operating activities. They are operating activities, okay? They are operating activities. In CA final, one examination question is given, okay? CA final exam question, super question, okay? There is a company called Knight Limited. Okay, do I have CA final accounting standards? Do I have? I'll show you the question, okay? Very interesting question. तो स्टूडेंट्स में जाओ, बोर्ड ऑफ नॉलेज, बोर्ड ऑफ स्टडीज में जाओ, न्यू स्कीम नहीं है, ओल्ड स्कीम में जाओ, फाइनल में जाओ, फाइनेंशियल रिपोर्टिंग में जाओ, प्रैक्टिस मैनुअल में जाओ, प्रैक्टिस मैनुअल में अकाउंटिंग स्टैंडर्ड्स में जाओ, वहाँ एक प्रॉब्लम होगा. कंपनी का नाम है नाइट लिमिटेड विच सेल्स बियर. ओह माय गॉड. क्वेश्चन नंबर 11. Sir, you remember questions like this also, sir. If there are 2000 questions, I remember 2000 questions, the entity name also, product name also, I can search with answer also. If the answer is 16.32, I remember that 16.32 also. Understand? Congratulations. Now we'll see this question, okay? Very interesting question. Knight Limited sells beer to customers. Small innocent people we are. Why you are teaching this kind of problems? What should I do? ICA has given this in their final main exam. 5 marks gone. People will write wrong answers. Knight Limited sells beer to customers. Some of the customers consume the beer in bars run by Knight Limited. So Knight Limited has a bar. People come consume. While leaving the bar, you are going back home. The consumers leave the empty bottles in the bar. Empty bottle is there, no? They will leave it there. What company will do? Company will take possession of these empty bottles. So company is looking when the guy will go. The moment the customer goes, they will say, ting, they will collect that empty bottle. Will they throw? No, they will sell it. Will they throw that empty bottle? No. What they are doing? The company has laid down a detailed internal record procedure, internal controls. Oh my God. What is this? They are keeping all these bottles in lock and key. One proper godown is there. They are maintaining it with a record on 22nd March 2021. How many empty bottles are received? 228. Like that, they are recording and they are keeping in safe custody. Procedure for accounting for these empty bottles. Accounting is also done, which are sold by the company by calling tenders. What they do? They sell these bottles. After 10 days, 15 days, they accumulate. Once 10,000 bottles are there, they'll call scrap vendor and they'll ask, by 10,000 bottles hai, kitna doge? Keeping this in view, decide whether the inventory of empty bottles is an asset to the company. On the balance sheet, you have 10,000 empty beer bottles in your hand on the date of balance sheet. Okay. Is it asset to the company? Guys, tell me the answer. Super question now. Yes or no? So that empty bottle, whatever is there in the custody of the company on the balance sheet date, on the date of balance sheet, you have say few that empty bottles are the assets. Obviously, yes, they are assets of the company. Then if so, whether the inventory of empty bottles existing as on the balance sheet date is to be considered as inventory, and should it be valued as per accounting standard 2, or should be treated as a scrap showing realizable value in the other income? So do you think it is accounting standard 2 inventory, or do you think it is scrap? So answer bolo. Do you think it is other income or operating income? Do you think it is accounting standard 2 inventory valuation should be followed? All variety answers will come now. Okay. The answer is the empty bottles in the hands of the company is not scrap. It is not other income. Accounting standard 2 should be followed. 100 out of 100 students will write other income scrap. Gone. 6 marks gone. Go in the. Sir, why accounting standard 2 is to be applied, sir? Simple. They have indirectly given you a hint that the company has internal control record procedures for accounting, means this empty bottle passed the materiality test. If it is not material, why are you having records for that? A detailed records are maintained means it is significant income for you. You cannot just say that it is scrap. Surprisingly, accounting standard 2 is to be applied. Super no. Accounting standard 2 is to be applied. And it is not other income, it is operating income. So like this 105 questions are there. So these are principal revenue generating activity. Now that empty bottle, is it principal revenue generating activity for you? Answer is yes. You sell those bottles and they are revenue generating activity in the normal course of business. Okay. Now, what are the examples? These are the examples. Cash receipts from sale of goods, cash receipt from royalty, fees, commissions, other revenue, cash payment to suppliers, cash payment to and on behalf of employees, cash receipts and payments of an insurance entity from premiums. If it is insurance company, from premiums and claims. Cash payments or refunds of income tax, cash payments relating to futures, forward contracts, derivatives, options, swap. You don't know all these things, okay? Derivative accounting, chhod do. In accounting standard 11, little bit of forward contracts will come, but you don't know, you do not have this in your syllabus, chhod do. Then cash flows arising from the purchase and sale or dealing with the trading securities. Trading securities means buying shares, selling shares. You are buying share, selling share in the short term, normal course of business. Then it is operating activity. Investment company, you are an investment company. Tata Holdings Limited, Tata Investments Limited. You are selling share, buying share. That is operating activity for you. Then cash advances and loans made by financial institutions. There is one bank or NBFC. There is one bank or NBFC. They are giving loans. That is operating activity for them. If I am borrowing money, that is financing activity. If I am giving loan, that is investment activity. But if State Bank of India is giving loan, you cannot say investment. No, that is operating activity for State Bank of India. They are borrowing money from another bank. That is not financing activity. That is operating activity for them. You understand? So these are operating activities. Now what are investing activities? Read this list. Cash payments to acquire fixed asset underline including intangibles. Oh my god. Including research and development activity capitalized, including self-constructed fixed assets. Cash spent, expenditure on any of these things, fixed assets, tangible assets, intangible assets, research and development, internally constructed assets, everything is investment activity. Then cash receipts from sale of property, sale of PPE, sale of intangibles, sale of other long-term investments or assets. Cash payment to acquire equity or debt instrument of other entity. You are buying shares of other entity, investment. Cash receipt from sale of equity or debt instrument, investing. Cash advances, loans made to other parties. If you are a financial institution, this is operating activity. But you know, for example, Tata Motors. Tata Motors is giving loan to one of the group entities. That is investing activity. Tata Finance is giving loan to other entity. That is operating. If you are financing institute, financial institution, bank or NBFC, you are giving loan, operating activity. You are taking loan, operating activity. If you are a normal entity other than bank or NBFC, giving loan, investing activity, borrowing loan, financing activity. Once or twice, simple dude. If you are giving loan, where will you show? Where will you show? Tell me. If you are giving loan, where will you show? Here you will show, na? If you are giving loan, here you will show investing. If you are taking loan, here you will show, na? Financing. Simple, no? So students are confused. Loan given, loan taken. What to do? Simple. When you give loan, where will you write? Tell me. Loans given, you will write in asset side. So that is investing. Loans borrowed, you will write in left side, liability. That's all. Future contracts, forward contracts, you can leave these 2 points. They are not for you. Financing activities. Pavans are examples below. Simple issue of shares, redemption of shares, buyback of shares, right shares, loans borrowed, loans repaid, interest paid. That's all. You understand? So shall we do some problems now? Hello, are we ready to do some problems? There are so many problems we'll do, and important thing is, in both accounting standards it is there AS3, in chapter also it is there, no? In unit 4 it is there, in chapter 4, I think unit 2. So we have to do lot of problems. Shall we do?